This is the only thing which you have to revise it again and again and again. The three criteria. The three criteria according to the US law. And this is very, out of these three criteria, if a country fulfill 2 out of the 3 criteria, there is no need to fulfill the 3 criteria. 2 out of the 3 criteria, if it is fulfilled, US Treasury Department can put that particular country's currency in the currency manipulator list. Now we will see that. Okay, so according to the US Trade Facilitation and Trade Enforcement Act of 2015, the 3 criteria is, first one is bilateral trade surplus with the US. First criteria is that it should be a US major trading partner, and that trading partner should have a trade surplus with the US. So it means that, take the case of India. India will have trade surplus, US will have trade deficit. Okay. Trade surplus of how much? At least 20 billion. So 20 billion and above. For a 12-month period, for a year, if you take a year, that particular country should have, one criteria is that a particular country should have a trade surplus of 20 billion in US dollar and above for a 1 year period. That's the first criteria. So see, all these things we have studied in the balance of payment. What do you know? What is trade surplus means? Trade account surplus. And how much is the amount? It's a fact, but very important. 20 billion US dollar and above for a year. Trade surplus, 20 billion above. Second criteria is current account surplus. And that particular country should have current account surplus with the US. Okay. So no, first one is with the US, second is generally current account. So take the case of India. Okay, take the case of India. India should have India's BOP should have a current account surplus equivalent to 2%, at least 2% of GDP for a 12-month period. So this India's fulfilled the first condition. With the US, India is having a trade surplus of above $20 billion. But India have not fulfilled the second criteria. We know that once we complete the 2021 only, we will have current account surplus. But that is not 2% of GDP. After 20 years, we are having current account surplus. Okay. So according to US, India have not fulfilled the second criteria. That is India having a current account surplus of 2% of GDP for over a period of 12 months or 1 year. So India have not fulfilled the second criteria. So then what is the reason India have been put in that list? India have fulfilled the third criteria. Third criteria is persistent. Persistent means continuous. A continuous one-sided intervention by RBI, whereby RBI have purchased, net purchase. So RBI will sell also, RBI will buy also. So net purchases of that foreign currency is 2%, at least the RBI net purchase is at least 2% of that country's GDP over a 12-month period. So if you take a 1 year period or 12-month period, RBI have intervened in the foreign exchange market and it is having a net purchase of US dollar which is coming around at least or minimum of 2% of GDP and above. And this will be conducted repeatedly. Out of 12 months, this one-sided intervention happened in at least 6 out of 12 months. So out of 12 months, RBI have intervened in 6 out of 12 months and have accumulated, so the net purchase is at least 2% of GDP. So this India have qualified. And if you take into consideration the second half of 2019 and first half of 2020 have been taken into consideration for the 12-month period. So India have fulfilled the first criteria and third criteria. There is a very high chance that they will ask you what are the 3 parameters, and they can also ask on what parameters India have qualified to put under the monitoring list. Now, so India breached the first and third benchmark. On the second factor, if you take a 4-quarter basis, the country's current account surplus remained below the threshold level. Okay, we know that. Now, what are the reasons for putting India in monitoring list? We already discussed that. India for several years have maintained a significant bilateral trade surplus with US, and currently it is about $20 billion. As of, if you take up to June 2020, India's bilateral trade surplus is 22 billion. So first criteria have been fulfilled. Now based on the RBI's intervention, India's net purchase of foreign exchange data in the second half of 2019 have been very high. Okay, so following this, and so the second half of 2019 RBI have intervened, plus in the first half of 2020 during the COVID pandemic time period, okay, there have been huge inflow of foreign currency due to India. See, try to understand, many developed countries, they have went for lower interest rate, they have injected liquidity. See, imagine all the foreign investors is having a lot of money, US dollars and other currencies. So what they will do, they will go and invest in an emerging market economy like India. So when we were having lockdown and other related pandemic related problem, there was no problem in the stock market. Why? Because foreign portfolio investment was coming. So already 2019 also RBI intervened in 2020 due to pandemic induced inflow for safer investment in Indian capital market. So RBI have intervened, resulting in, by saying that okay, during this period alone, that is following the sales during the initial onset of the pandemic, Indian sustained net purchase RBI net for first half of 2020, which pushed net purchase of foreign exchange to 64 billion or 2.4% of GDP over the 4 quarters through. So India, not 2%, India have crossed 2.4% of GDP. Third criteria, first criteria and third criteria. Second criteria, we know that India have not attained till now.